All right, in the world of high finance, it feels like there's a new power couple on the block. On one side, you've got the old guard, the titans of Wall Street. We're talking investment banks. And on the other, this newer, faster growing force, private credit. Their whole relationship is totally reshaping how companies get funded. And let me tell you, it is getting complicated.
So, what is the real story here? I mean, are these guys partners working together to get deals done? Or are they just fierce rivals duking it out for the same piece of the pie? Well, the answer, it's a bit of both. They're kind of like frenemies. And honestly, that's what makes this whole thing so interesting. So let's dive in and unpack it. Okay, first things first, let's get to know the players. In one corner, you've got the established powerhouses, the big brand name investment banks. For decades, they've been the undisputed gatekeepers of corporate finance, right? And then in the other corner, you have the challenger, private credit. These are these nimble, super specialized funds that have just exploded in size and become a massive force in lending. So to really get a grip on this relationship, let's start with how they actually work together, because they do. A key role an investment bank plays is being the ultimate matchmaker, connecting companies that need cash with the folks who have it. Just imagine for a second, you're a company and you need to borrow a ton of money. What do? Well, you hire an investment bank to be your guide. Their whole job is to figure out the best way to get that money, find the right lenders for you, and then negotiate the best possible terms. They're basically the expert you have in your corner. And this is exactly where that partnership really comes to life. So a company needs capital. They hire a bank. But here's the twist. Instead of just looking at public markets, that bank now often connects them directly to a private credit fund that's got the cash ready to deploy. The deal gets structured, the bank gets its fee, and really everybody wins. All right, now let's talk about the second big way they partner up. And this is a big one, especially when you're talking about massive deals. It's all about slicing up the pie, sharing the risk, but also sharing the reward. So picture this. A huge private equity firm wants to buy a company for billions of dollars. That's what we call a leveraged buyout, or an LBO. Now, one bank usually can't or just doesn't want to lend all that money itself. It's too risky. So what do? They syndicate the deal, which, by the way, is just a fancy way of saying they set up the loan and then sell off pieces of it to other lenders. Like, you guessed it, private credit funds. But here's where it gets really clever. They don't just split it down the middle. No way. The investment bank will usually keep the senior debt for itself. That's the safest slice of the loan, the part that gets paid back first if anything goes wrong. Then they sell off the riskier but higher reward pieces to the private credit funds who have an appetite for that kind of thing. See how that works? The bank minimizes its risk, and the fund gets a shot at a higher return. It's a pretty perfect symbiotic relationship. But, it's not all friendly cooperation and high fives. Not at all. The power dynamic here has been shifting in a major way, and that has turned these partners into some pretty fierce competitors. So, how on earth did that happen? Well, it all comes back to one year, 2008. The global financial crisis wasn't just some market crash. It fundamentally rewrote the rulebook for banks. And in doing so, it kind of accidentally created the perfect opening for private credit to storm onto the main stage. See, after the crisis, a whole bunch of new regulations came in to make the banking system safer. But they had this major side effect. The new rules made it way harder and way more expensive for the big banks to hold certain kinds of riskier loans on their balance sheets. And that created this huge gap in the market. Someone had to fill it. And who rushed in to fill that void? Private credit funds. They weren't bound by the same strict rules, so they saw a massive opportunity. But the investment banks, they weren't just going to sit back and watch. Their response was basically, if you can't beat them, join them, and then compete with them. They started launching their own private credit divisions, and just like that, partners turned into direct rivals. And that really brings us to the heart of their frenemy relationship today. It's this dual reality. On one hand, yeah, they still partner up. Banks advise companies and syndicate these massive deals to private credit funds. But on the other hand, they are now competing head-to-head, with their own funds fighting to win the exact same business. So where does all this leave us? Well, it leaves us with a totally new set of rules in the world of finance, a new reality that's defined by a future that is both symbiotic and intensely competitive.
This isn't some simple story about a new challenger coming in and replacing the old guard. It's really a story of adaptation. Investment banks saw the entire financial landscape shifting under their feet, and they evolved right along with it. They became key players and partners in the very market that was challenging their old dominance.
So yeah, those old, simple roles, they're pretty much a thing of the past. Today's financial world is defined by this really complex frenemy dynamic. Banks and private credit funds, they need each other, they work with each other, and they fiercely compete against each other. Sometimes all on the exact same deal. It's wild.
And all of that leaves us with one last fascinating question to chew on. As this codependent, super competitive relationship keeps evolving, who's really in charge here? Who's pulling the strings? Is it the old guard, adapting to the new rules, or is it the new challengers, who are now setting them? The answer to that is going to define the future of finance for years to come.